guys, and welcome to Zero Risk Forex. This is video number 6. In this video, I'm going to break down the zero risk formula. I've been in the Forex market for about 9 years. Over the past 3 years, I've been making very slow and consistent profits after losing so much money, blowing up so many accounts, and quitting on several occasions, but always returning because I always knew that there must be a way that someone or people make money. That 3% of people that make money, there must be a way they make that money. And that's how I came up with my own strategy, and that has been working for me very nicely. And that's what I try to share to you guys on this channel, Zero Risk Forex. I'm not a content creator, so the quality of my videos may not be as elegant as what you're used to on YouTube, but I promise you the content is very worth it, especially if you are a trader, you've been trading, you've lost money, then this is very valuable content. Okay, now let me carry on. Now, price, right? Let's look at this chart, right? What I try to tell you about zero risk forex, right, is this panel over here on the right. This panel over here is the most important thing you need to understand when trading. Okay, now let's just imagine the price is at $7. This could be Bitcoin, this could be anything in the world, right? Let's just imagine something's price is at $7. That means between $7 and 0, there's exactly 700 points, because between $6 and $7 there's 100 points, 601, 602, 603 up to 7. And same thing goes for everything else, right? Now look at this chart, this price panel. It started from 0. Price, the highest it's been so far is number 10. $10. That's the highest price this thing has gone up to. But the current price is 7. Okay, guys? This brings me to bulls versus bears. The people who like to buy versus the people who like to sell. The long traders versus the short traders. And why you, as a trader, if you want to be in this trading game for a very long time, you should always be on the long side. Now, the price is currently at $7. The highest price it's been is $10. The bulls are looking for buy opportunities, and the sellers are looking for sell opportunities. The bulls want the market to go up, the bears want the market to go down, right? Now let me ask you a question. The price is $7. If I asked you, what is the highest price this has ever been up to? The answer is 10. You can see it clearly over there, right? Now, if I asked you another question, what is the highest price this can ever get to? everywhere goes silent, because it is impossible to predict the highest price anything can go up to. You can't predict the highest price an egg can go up to, a can of beer, water, petrol, your phone. It's impossible to predict the high, right? Now, what if I said, what is the lowest this can ever get to? The answer is 0. So, as a long trader, you can always use 0 to calculate your lot sizes. Okay? That is why you should always be on the long side. If I'm on the sell side and the market goes up against me, the sky is the limit. Where do I set my stop loss? Where is it 0? How do I calculate it? So in this scenario, I've got it. Let's just say I have a 250 pounds account or dollar account. I go to my risk calculator. There's my $250. Let's just imagine it's the USD JPY. The distance to 0 is 700 points. When I put that calculation inside there, that tells me that I should be trading 0.36 cents or pounds and 0.36 pounds per point, which means if I enter a buy trade right here, the only way I am going to blow my account is if that price suddenly goes from $7 all the way back down to 0, which in my opinion is not going to happen in my lifetime. The USD JPY can never become a 0. Gold, the price of gold can never become 0, right? The price of the Nasdaq can never suddenly become 0. So this is a probability trade, right? If the market goes up, each time that market goes up to 701, I make 36 cents. So I'm making 36 cents each time, up until it gets to 36.8, and it keeps going up. And every market, if you look at every market, generally, every market is on the upside, because the price or value of fiat currencies are going down. So if you go to your supermarket, most of the things, the prices are up. And that's the same thing with everything else. The prices generally are in an upward trajectory, right? Secondly, which brings me, in this scenario, you do not also need stop losses, right? Because 0 is always your benchmark, 0 is your support, right? In the traditional trading, they tell you to risk 2.5% of your account size, right? When predicting, you never know which direction the market is going to go. They say, oh, put your stop losses there, do some stop losses. And basically, that's how the money makers make money. They just hit your stop losses, make money. If you've got 1 million retail traders on the buy side, 1 million on the sell side, and each one is set a stop loss of 2.5% of £1,000, just imagine $25 times 2 million. That's how much they've made in a few minutes by hitting all those stop losses, right? So to me, that traditional way of trading, where you set stop losses and they just hit your stop loss, that's not the way to be trading. Okay, so zero risk forex is calculating the distance between 0, using that to divide by whatever your account size is, and that is how much you should be trading per pip. Notice I said per point, I said per pip, I didn't say per lot size, because there's a difference. Which brings me to positive and negative swap or some people call it rollover. Positive rollover versus negative rollover, which is something I have never heard anyone talk about in most of the YouTube trading forex videos I've watched. And I tell you, I've watched hours and hours and hours of trading videos on YouTube. All that time in the last 7-8 years, people spend watching football, basketball, all those type of things. I've spent them watching trading videos. I don't think I've ever heard anyone talk about positive or negative swap, but I'm here to speak about it today and why it is very important. Now, I've already spoken to you about why you should be a bull trader, right? So now you've entered a market at $7, right? And you're on the buy side. You've calculated the correct lot sizes, the correct how much you should be trading per point, right? You've calculated all that correctly. Now the next question is, when you enter that market, there's one thing that is always present, and that is time. How long will it take for price to reach your target? If it goes down from $7 to $4, even though it's not going to hit zero, what if it stays at $4 for the next 1 year? Right? It is very important for you to trade markets that give you positive, overnight positive rollover, because when you come across situations where your market goes down and it becomes just a waiting game, you have peace of mind, obviously, that the price is not going to hit zero. That's not the issue here. But the issue here is, with trading, the price goes up and down. It moves up in waves. It goes up and down. So what about those times when it's down against you and it's waiting? You don't want to be trading markets that give you negative rollover, which means every day that you're holding that trade, you are getting charged, right? So you're better off trading markets that when you're waiting during those times, those things are actually earning you money. And a good example of one of such markets is the USD JPY, right? When you are trading the USD JPY, when you hold the asset, no matter how long it takes it to go up to where you want it, you are earning positive rollover every single night, right? This is an example of a USD trade, JPY trade, that I opened on the 7th of November, right? Rollover is already 13 cents. This is positive rollover, right? Now, there's another asset, the USD JPY, that opened on the 8th, right? This is a negative rollover asset, and look at how much it's charged me, minus 23 cents. So now imagine if I'm waiting for this trade to go in the upward direction and it takes another 1 year, 2 years, 3 years, 4 years, 5 years, and they're deducting that. Even eventually when it goes up and I make my profit, when you calculate how much rollover or negative rollover that has been taken, it eats into your profit. So the number 2 thing after understanding your risk management is this very important point that I'm making here. There are so many markets that give you positive rollover. It's better for you to trade those type of market. What is the point predicting a market? Because at the end of the day, trading is trading. Things go up, things go down. You do your risk management, you want the things to go up. You're better off trading things that will give you positive overnight positive rollover, what you're making money while you sleep, right? This 13p that I've made to open this trade is $30, right? So even if I hold this trade for a whole year, this one is going to give me at least 40 to 50 cents every single week. If you multiply that by 52, right, that's already about $20 or £20. So if I'm making £20 on a market that's cost me $30 to open, and I'm just holding it for a whole year, as long as it doesn't blow my account, and I'm making $20 on a $30 market, that's a margin requirement. Hey, that's a good return. How much are they giving you in your bank? Right? And this is not the fact, I'm not even talking about the fact that the market might even go up in my direction. When it goes up in my direction, that's even more profit. So trading markets with positive rollover, very important, guys. Okay, very, very important. Which brings us to our live account. At the moment, I'm trading USD JPY. I've got two single lots of them, I've got gold, and all these are long trades. Okay, I also got the Nikkei, Japan Nikkei. I previously said USD JPY. Sorry, that was an error. This is the Nikkei. It's giving me negative rollover. Okay, I've got that buy. Okay. The current balance is 35835. In the last video, that balance was challenge 1. In week 5, which was last week, that's where we were. You can go and watch that. So all these videos are on my channel. Okay, you can go and watch it. So that was the previous balance. And this is where we are today, 35324. It's 358, but the next one here is 362, so I can't really put it there. So I put it there. Week number 6, we've done it up to number 14, and that's our current balance. All right. If you're new to this channel, what you have here is a challenge. The account balance was 250 on the 30th of September, which was a Monday, the first day of a trading week. And the aim is to try and compound this 250 account by 2.5%, 250 times, right? And we want to try to do that once each week, right? But so far we've able to do it 14 times, and this is week 6, 11th of November, that is today, or 10th of November today, and that's our current balance. Okay, if I can do this 250 by 2.5%, 250 times, so that when I get to up to 50 times, that's going to be my balance. If I start with that balance and do another 50 times, that will be the new balance. If I start with that balance over there and do it another 50 times, that's what the balance would be. This is compound interest, right? And if you start with that balance there, you can do it by the 200th time. That's what it's supposed to be, the balance. And when you start with that balance, by the time you get to 250, that is what the law of compound interest says. So that's the challenge. We've done it 14 times, and this is just in 6 weeks, right? So we're making very good headway. Please subscribe to this channel. Follow me on this challenge. Okay. Yes, last week I was trading the NAS. That was our entry point. over there, if you watch the previous video, this was our entry point. The market came down. I took another buy there, which was also in that video, and the market has risen from there all the way up there, and this is where all that profit comes from. Okay, so that was the NAS. If you look at the other video, we also did the France, which went up from there to about there, so that also was closed. Now what I did was I took a USD JPY trade and a gold trade, and that's what we're currently on, because my indicator, which I'm not going to speak a lot about in this video, which is the Williams R indicator. This is one indicator that I use to perform my technical analysis as to when to enter each market. So this is what I use to decide when to buy. Yeah, I use that indicator. Okay, if you look at all my previous videos, I speak about this indicator, but I'm not going to speak about it in this current video, but it's something I would definitely carry on speaking about in videos to come. Okay, so I think I shall leave it there from now. Our live account is at 358. Today is Sunday. I'm looking forward to this coming week, and join me next week. Subscribe to this channel, where I'll be making video number 7, which will cover all the stuff that has gone on this coming week, and we'll go through the whole zero risk forex strategy all over again. All right, guys, thanks for watching. Wishing you guys a lovely week ahead. Ciao.